The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs.
All right, so this is the exciting part. I'm going to introduce you both. I'm very happy to do this. And Carl and Stefan, just before we began, I revealed the secret, which is that I don't read your bio. Thank you for sending it to me. I just find stuff on the internet about you and I reveal it to everyone just before you begin speaking. Are you ready?
Hopefully.
So, Carl, I'm going to start with you, and some of this may or may not be true. I don't promise that this is you. It is a Carl Schultes. I don't know if it's you. National Surety and Practice Leader. Is that correct?
Yes.
Got undergrad in Finance and International Business from Concordia University.
Correct.
I think you're an associate risk management, construction risk, insurance specialist, and maybe speak a little bit of Francese.
That is correct.
Also, this is some things I think are true. Okay, this is the I'm not sure. So, I think you live in Portland, Oregon, but you were born in Canada.
Correct.
And a little bit of a DIY remodeling kitchen and bathroom guy. You into that?
Yes.
And did you recently win a Rainmaker Award in the Portland Business Journal?
I did.
Married, 2 sons, and I think your beautiful wife is an author and illustrator of children's books.
That is correct.
They're good, folks. Y'all need to check them out. They're on Amazon, for sale now. Rebecca is her name. And this, I'm taking back over. I got a picture, I think, of giving myself the role of presenter. I think, Carl, that you are a super active, super athlete cyclist, including cycling, mountain biking. And folks, I'm not talking like he occasionally gets on a bike. I'm talking 500-600 miles a week. The list of awards and like podium finishes on Strava, I don't have time. I mean, like I saw 20 or 30 years worth of like success, and I'm not mentioning times because you're faster than me, both on a bike and I think you run. I think I saw some running or some Ironman stuff. So no times, folks, because he's faster than me. Is that true?
Yes, it is.
All right. Stefan, now on to you. Stefan, Senior Surety Account Executive. Is that correct, sir?
That is right.
You have an undergraduate in physics from
Yep.
USC and a master's in applied mathematics from UCF. Is that correct?
Yeah. That's right.
How do you get a degree in physics and a master's degree in applied mathematics and end up in surety?
That's a question I still don't have an answer for.
And I'm talking like, is it true that the insurance licensing test must be pretty hard because you passed, but not by 100%?
Yeah. Wow, that's impressive that you found that. Yeah.
You are an associate in fidelity and surety bonding and a construction risk and insurance specialist. You're also in Portland, Oregon, but I think you were born in Florida. Is that correct?
Born in Arizona, lived most of my life in Florida, but yeah. Yeah.
All right.
There.
All right. Okay. That's a negative. That's a -1 on mine. Are you a surety marketing expert by day, thrill seeker, and adventurer by night?
Absolutely.
Do you listen to Taylor Swift while you're doing deadlifts in the gym?
I don't usually tell people that, but yes, that is my secret power.
In the movie Three Ninjas, what word does Race Nelson say repeatedly?
Oh boy. Oh my gosh. Too embarrassed to say that I even know this. I can't believe you found this. It's so impressive. Um,
It's one word,
nope, I'm not even no, because then people will know.
dude. And then now, I don't know if this is true, and I hope this is going to ruin everything that we've just established if this isn't true. But I think that you left Florida. Some might think running from the police, but it wasn't. It was because of a girl. Is that correct?
That's right.
And is that girl still around plus 2 dogs?
It's not around, but I have a funny story that I'll share very shortly about that.
Okay, well then I won't show the picture I was just about to show. So, all right, I'm going to stop sharing and I'm going to let you, Stefan, I'm going to give you back control Um,
Right.
oh, I'm really glad that we had that kind of like pre-conversation there before I showed a great picture and then went into
I'm sure it's still a
but
great
very
picture.
impressive. Great background. And Stefan, one thing I saw as a goal of yours, and a goal, setting goals seems to be important to you, is I saw marathon and ultra marathon. So have you, that was a while ago that I saw that as a goal. Have you done a
I have,
marathon or ultra marathon? Tell me about it.
yes, I ran two halves in the last year and a half, and I ran a marathon, although it was not an official one because of COVID.
Hmm.
So I just ran one on a local high school track by myself, essentially. I have not done an ultra yet. That is on the list of things to still do, but it will happen. As I think all of us, as we get older, our needs just get worse, and ultra marathons are very hard in that case. But I will do it, whether I have to walk it or not.
Well, I yield the floor to you, sir. I am going to mute myself and then I'll hit you up with some questions when you pause.
Perfect. Thank you so much, Robert, and thank you everybody for joining us. I really love Robert's ability to find dirt on presenters. That was incredibly impressive. Uh, so we are Carl Schultes and Stefan Engelhardt. You know, we want to talk about surety bonds and their value in financial management. We're going to go over a handful of things today. I'm going to start you off with just helping you all get a little bit more information about Carl and I. I'm a big proponent of, I'm not going to tell you things that you can find on LinkedIn or that you can Google yourselves. You might not have the detective capabilities of Robert, but you know, I like to share some things about ourselves so you can feel more comfortable messaging us after or calling us. So I'll start with who are we, and I'll talk about the fundamentals, and then Carl will go over the last few things. But most importantly, you know, I want to talk about Carl. He's an excellent mentor. He's a great manager, a friend. He's also Canadian, as Robert said, and I'm 90% sure that it's a legal requirement to play or watch hockey if you're Canadian. But because he's Canadian, he's also very confused on what's going on in the US media. But in his defense, I think we all are lately. But lastly, he disagrees with me on really only one thing, and that it's my incessant need to compare myself to people like Elon Musk and Jeff Bezos. He doesn't like that, and I do it all of the time. A little bit about me. I'm a dreamer. I'm a huge goal setter. I love to play ultimate frisbee. I'm surprised that didn't come up. I've moved across the country 4 times in the last 6 years, and when I say moved across, I mean from Florida to Oregon, and then Oregon to Maine, and then Maine back to Florida, and then Florida back to Oregon. So I'm very good at road trips. I'm very good at packing a U-Haul, and I'm very good at dealing with dogs in a car for multiple hours. So if you need help with that, I'm happy to help you out with that or surety. So let's talk about the surety fundamentals. You know, I'm here to entertain you a little bit, but also educate you. So we'll talk about surety. And the biggest thing I want to talk about is that surety is not insurance. It's very similar to insurance. A lot of the names of sureties will be the same names as insurance companies. So Travelers, Liberty Mutual, they're all parts of insurance, but they are not an insurance product. And there's 3 main points I want to talk about surety that is not on here and that you might not necessarily find online, at least in detail. And one is that surety is a 3-party agreement. You will see that a lot, but it's very different is the reason you'll see it a lot. And that's because as a 3-party agreement, sureties will list, as you guessed, 3 parties. Usually it's only 2. It's the owner and the person doing the work. In surety, it's the beneficiary, which would generally be the owner, the person doing the work, or the client, or the principal, as we like to call it, which is generally you, and then the surety, which is the insurance company who backs that work. The biggest part about this is that this surety company here, again, they're not like insurance. They're going to make sure that you as the principal will fulfill the contract. And if they don't, they're going to do 2 very unique things. One, they're going to make sure, and they don't want to do this, but if they have to, they'll pay out on a claim. They don't want to do that. But more importantly, they're going to step in and try to fulfill the contract for you. They'll help you find whether it's another group to step in and help you. They give you money because you're having cash flow issues. Whatever it is, their main goal is to make sure that contract gets finished. The second unique thing is surety is underwritten on the basis that there's 0 losses or that there's no loss at all. So if there's any reasonable chance that there's going to be a loss, they're not going to give you a bond. They're not going to write a bond. They don't want to work with you. They don't like that. Whereas insurance, it's founded on the basis of losses, very high losses, and the premiums reflect that. So in surety, it means if you're able to get a bond or you're able to start a bond program, that tells the beneficiary, the obligee, that you are financially sound. It shows that you do good work. And that's a really great process for them to understand how great of a company they are working with. This also works with things like subcontracting. If you want your subcontractors, if you have anyone or people, anything you have a subcontract, any company you have a subcontract with, and you want them to be vetted by a billion or trillion dollar company, have them put up a bond. It protects them to fulfill that contract for you. It also protects you and your contracts and your business operations. So it's a fantastic vetting opportunity to get business done correctly. And the last thing is with insurance or things like letters of credit, which we'll talk more about later. In a claim scenario, it's always you versus the claimant, right? Everyone's probably been through that, whether it's a personal situation with your car, you got hit, or you hit someone, or your house lit on fire, whatever it is. Everybody's been through claims, and they're a nightmare, and we all hate it. But with surety, it's different. They vet these claims. They know, again, they don't want to have a loss, so they're going to do everything in their power. They will fight with you and for you to make sure that if there's a scenario that comes up, you and they, because you're in it together, are not going to have to pay out or whatever it is. They're going to make sure it gets right as done best for you. So that's really three unique things. Again, there's a lot more. I'm not even going to say the things on this page because you're going to get a copy of this and you can ask me more about it later. The next thing is, how do you qualify? Or what are the pre-qualification parts? And in surety, we like to say there are 3 C's. I don't really like them, but I think they're a good way of explaining them, and it's character, capacity, and capital. Character is, of course, who are you? What is your business? What do you do? Capacity is, what's your ability to do that work? How large are the contracts that you're entering into? How long have you been around? What are you capable of? And capital, and I don't think I really need to explain this, but it's, of course, what's your financial ability? You know, we can talk later at the end of this about what items that we generally collect. If you're in need of a surety bond, or you think you may be able to use a surety bond in lieu of a letter of credit for something, you know, very, very similar to debt facilities, there are financial statements that we'll need, and figuring out your covenants, your banking relationships, all these different things are things that we'd like to look at. And one other thing I'd like to talk about, the communication cycle. A lot of people wonder what it's like being a broker. And if you look at this, there's 2 arrows pointing to broker and only 1 arrow pointing at all the others. I'm not going to say my job's harder than yours. That would just be ignorant. But really, we are beholden to you as clients, but we also have to work within the laws and guidelines that are mandated by the federal government, the state government, the sureties covenants. So there's a lot of having to work within the lines to do best by you and help you, but also make sure that the surety who's underwriting this on 0 losses gets the best picture and writes good business. So it's a very hard balancing act a lot of the time. And I think the majority of our work is making sure that nobody's waiting on us for something, because generally that's the way it goes, is everything comes back to us back in the middle. And we have to make sure we get questions and answers to those who need them. So that was very quick. That was a lot of things. I talked very fast. I'd like to make sort of a joke about surety and its importance in the world. And if anyone's taken world history, you know, I'm sure they've taught the earliest known surety contract existed in 2750 BC. That was very important. I have that somewhere on my wall. Probably not. But you know, there was a long time where nothing really interesting happened, I think, in the world. Other people may argue that. But truthfully, surety's been around for a very long time. And the Miller Act was founded in the early 1900s, essentially requiring performance bonds for contracts of specific sizes. This is essentially because if a contractor shows up and they're building a city hall, for instance, they need that work to get done, right? And it's not, we want your money in insurance. We want your money if you don't fix it. No, we just need it to get done. And that's why surety exists, is it's the fulfillment of a contract. It's not about the money. It's about getting things done. And that's really what we see in surety. Today, there's $3,647,000 in surety premiums. It's a big industry. It's not as big as insurance, but it's big. And we do a lot of work. And Carl's and I's job is trying to find ways to integrate surety in other industries and other ways that it hasn't been used before to find the same solutions. That was quick. I think I did it under 10 minutes. I'm not sure if I did, but let's go to questions. That was a really quick basis of surety.
I'm interested in exactly what happened in 2750 BC.
2750 BC.
Yeah.
So they wrote on the walls of a cave, essentially it was a farmer had to leave, if I remember correctly, a farmer had to leave, but he wanted to make sure that his sheep and his flock was tended to, and that his crops were harvested, and that he would pay a certain sum to the person who did that. So this contract, which was on essentially on a wall, it wasn't even a stone tower, they just wrote it on the wall, to make sure that one, permanently everyone knew that this X person, I don't know their name, would do that, and that they would get paid for the work that they did. So it was a payment bond. Yeah, so that's a real thing. I'm surprised I remember that, to be honest.
Speaking of, Stefan, a couple of like vocabulary type questions. We've mentioned different types of bonds, but I just want to ask you about some of the things you've already said, if you could just define, and then a couple that you haven't, but definition. I think this will help establish a baseline for us. So one was, what is a performance bond?
So performance bond is, and these are very uncreative names for bonds, but performance bond is quite literally that, is you as a principal will perform a contract. So a very popular example, again, is building a building. That's most of surety, is contractors, actual contractors having to build stuff. So a performance bond is an assurance that the performance of the contract will be completed. So that the building will be complete to the standards that the owner wants it. And it generally, a part of that performance bond is a payment bond, and a payment bond is so that the subcontractors used will also get paid for the work that they help the general contractor perform.
That's good. That was my next question. The next one is a bid bond.
A bid bond is, and I'm going to use contract surety as an analogy here, but mainly what Carl and I focus on are commercial. So a lot of this goes over to the commercial world, which is really just everything else, whether you're in healthcare, whether you're in the renewable energy industry, it doesn't matter what it is. A bid bond is similar to a contract going up and there's a request for proposals, whatever it may be. When they want proposals, they also want to know what your bid, what's the cost of you going to do this work for us? And of course, they pick the lowest within reason. So a bid bond goes along with that, saying that if I put up a bid and let's say the engineer's estimate was $1 million, I come in at 500,000 and everybody else comes in at 700,000, it means that I need to now fulfill it for the $500,000 that I bid as the contract, because they're going to save a lot of money. They thought they would have to do it for $1 million. So that bid protects them in the case that I decide, oh no, I screwed up. I really should have put 600,000. Well, now I have to do it for 5. If I back out, it protects the obligee or the owner in the case that I back out or something else happens, because they're gonna lose time having to redo the bid process, if that makes sense.
What's a dual obligee bond?
Yeah, a dual obligee rider. So a lot of the times, these are three-party contracts. So it's the obligee, the principal, and the owner. Sometimes, especially in federal contracts, when we're working with the United States government, there will be two obligees. So very, very common in tribal work. They will have I have a current job going on where they have to write Department of Natural Resources. This is obviously the federal government. But on top of going to the Department of Natural Resources, the bond also has to list a beneficiary of the actual US federal government. Now, even though we all see them as the same people, they're two different entities technically. So they have to both be listed as beneficiaries to the bond because they have different reasons that they could make a claim.
My next one's warranty bond, but is it just that you're bonding the warranty that you've put on your, is it that simple? But what's a warranty bond?
Yeah, it can be that simple. They can be a little more complicated, but a lot of the times bonds in the contract world come with a maintenance period. So maintenance and warranty can be used interchangeably, but there are some subtle differences that I don't want to go over because I don't want anyone to call me out on it. But maintenances and warranties typically are a year following the performance of a job. A warranty bond, a standalone warranty bond or maintenance bond can come into play. They're rare, but they do happen. And it really comes more in the case of things like operation and maintenance than just making sure a claim doesn't come up a year after the fact, if that makes sense. So
Yeah.
Certain facilities need to be maintained appropriately. And so that's when a warranty bond can come into play because they have a high loss or a high chance of losses. So they want to make sure that if there's a case that there's not going to be a claim on the bond, but the people who did the work will come in and actually fix what they did. So there is not a claim on the bond.
Stefan, you mentioned the correlation between bonding and usually associated with an insurance company. Is that U.S. specific? Is there a different setup globally for members outside the U.S.? Are bonds often provided by something other than an insurance company anywhere else?
That's a really interesting question. And yes, sometimes bonds can be written. So there are two types of guarantee. I mean, anyone can guarantee anything as long as the owner's okay with it, right? I could write a contract for a private job, and if I had enough money, they might be okay with it. I mean, that in essence is surety. It's just not backed by the Department of Treasury's listing. So a lot of jobs, especially federal state jobs, they require, the reason it's insurance companies is required something called a treasury listing. So they need to know that you're an AM plus best rated company. They need to know you have some sort of financial standing that is regulated. So a lot of that is mandated and tracked, but not all of it is. And there are some sureties who don't have what we call as a T listing, and they can write bonds. It's just not for when the federal government is the obligee or when a state is the obligee. It's when it's a private owner. That does happen a lot. And then you can have these other risk management companies similar to brokerages can write their own bonds if they have enough of financial backing to do it. But again, it's for private owners and it's on a case-by-case basis. Those aren't tracked in any way though. So it's hard to talk about them unless it's on, if you're talking about a specific scenario when that happened.
Stefan, let's say you have a requirement in a contract that people who provide bids to you say you require a bid bond. Is there a way to verify the bond is valid? Is there like a best practice in that process?
Yeah. So, and you're talking about if the person I'm working with is the owner of the contract, so they're having their subcontractor post a bond. Yes, that's absolutely something we do. I've done that recently, actually, for a job based out of Florida. Is my client just was introduced to the surety bonding world. We wrote a bond with them to a state entity in Florida, but then they also subcontracted almost 50% of the work to another company. And so they were like, well, can we write a bond down to them? And I said, absolutely, you should. It protects you. So they did that. And we required that once they issued the bond, I required to them, they send it to me. And I did my due diligence to call the surety company and the issuing broker to verify the authenticity. There we go. I think I got that. Of the bond itself. And yes, that is very common.
I've got a bunch more questions. I'm going to hit you up with two, and then we're going to pivot over to Carl.
Great.
And I'll hold the rest of the questions until the end. Question number one of two is, we mentioned construction a couple times in examples. You said also commercial. What are a couple other industries where surety bonds come up a lot as a need or in use?
Yeah, that's a great question. We're going to talk more about that later, but to just briefly talk about them. One that's been really big for me personally has been the healthcare industry. I'm very passionate about making sure that people who are beneficiaries of Medicare and Medicaid can get proper treatment that they deserve. Um, so there are bonds in that space that help providers essentially not have to worry about carrying incredibly large balance sheets to be able to work in contracts with the Center of Medicare and Medicaid Services to help their beneficiaries, because that can be, a good thing about bonds is it can lower sort of the gate of entry for operating businesses, because otherwise you would either need an incredibly strong balance sheet or you need a banking relationship. So surety bonds can sort of be that way to get into a space that allows you to enter in contracts you would normally not. And again, you're still vetted, so a billion-dollar company thinks you have the ability to do it, but it's very big there for them because they're doing something they love. It's something that is important to me, and it helps everyone. The bond helps CMS, it helps the client, it helps the beneficiaries at the end of the day. So healthcare is a big one. Carl's huge in renewable energy, manufacturing and supply. With all the logistical problems that have come up lately across the world, manufacturing, supply, and distribution has been a very large part. That's technically commercial. I mean, really any industry, transportation, tech companies, really anytime there's a contract that has some sort of assurance, financial assurance or performance assurance, a bond can come into play. We've had very unique things. Carl's done one for a cruise line. We've done one for the supply of armed goods. That was really weird. Just a lot of
Carl,
stuff.
I'm sorry, Stefan. One last before we get to Carl is a question was around in the context of 401k trustee surety bonds. Can you speak a little bit more about that? That the underwriter is assuming a zero loss, that concept versus insurance assumes a loss. Can you speak a little bit more about the underwriting process assuming a zero loss in surety bonding and maybe use 401k trustee surety bonds as an example?
So there's a lot to say about the whole basis of zero losses, and there's two main reasons for it. One, they're looking again at your character, capacity, capital. What's your ability to do work? How long have you done it? And what's your financial responsibility to do that work? When they look at those things and they vet you and say that you can do this work, they're essentially betting that you're going to be able to fulfill that contract. They don't think, they would not write it otherwise. The second thing is this whole basis of zero losses is also founded because you have to enter into what is an indemnity agreement. If there is a claim and the surety has to spend any money at all, at the end of the day, they're going to come back to you and get paid back, right? So you have signed, whether it's on the business or it's personally, if you own the business, if they have to pay $100, they're going to come for you and say, we had to pay $100 on your behalf. We want our $100 back. So that also pads their loss ratio. Now, again, sometimes there are still other things that happen, so they can't collect, and legal fees are incredibly expensive. But between indemnity and their vetting process, it's the basis of zero losses. So I think the average historically, on my page here is 15.5%, which is fantastic. I mean, if we could all put our money together and start a surety, call me afterwards. We can figure that out because that's a fantastic business to be in.
That is great.
401k, too specific.
Yeah, that was great. I'm going to hold everyone else's questions. They're just piling up. It's like a ticker symbol over here. Carl, I yield the microphone to you, and I'm going to put myself on mute.
Thank you, everyone, and appreciate you joining us today. I want to take just a step back, addressing one of Robert's questions, or maybe addressing two of them, and talking about what surety is. So when we think about, when we say zero losses, it's no different than, and we'll talk about this in a minute, but it's no different than when you get involved in the loan process. When you take a loan from a bank, the bank isn't underwriting with the mindset that there's a percentage or a probability that there will be a loss and that you will not be able to pay them back. Everything is based on the assumption that you will repay them. And so that's number one. The second thing I like to use as an analogy when we're speaking of surety is I refer to it as co-signature. So if my son was needing to get a lease and didn't have the credit score necessary to get that lease for a car, and came to me and I co-signed it, I'm acting as a surety. Now, the difference is in the true surety, I would go back and have my son sign a document to me, indemnifying me that if I have to pay out to the lease company for a payment he didn't make or for walking away from his lease, then I can go back to him and say, you're now going to have to pay me back over the next 10 years. But that's what I like to think of as surety. It's a form of co-signature. Stefan used the term assurance. These are all similar terms that mean the same thing as we think of surety. But why it's important to understand is because surety has always been a big part of the construction sector, but we're seeing growth in surety really taking hold in other industries because clients and companies and beneficiaries are realizing that maybe they can accept a surety bond instead of a letter of credit or cash or any other form of, think of again, a co-signature. So we'll talk about some of these advantages. Can you move to the next slide, Stefan? So let's talk about, why am I comparing surety bonds to letters of credit? So first of all, surety bonds are very similar to letters of credit. Many of you who are all of you in the finance space, you either run into the need for a letter of credit or at least know what it is. And essentially, a surety bond does the same thing that a letter of credit does. And that is really where we see growth in our industry, is the utilization of surety bonds in lieu of letters of credit. And we're going to talk a little bit about why. Why does that matter to companies like yourselves or to CFOs for private and publicly traded companies throughout the U.S.? So first off, a letter of credit and a surety bond both operate in the same way, as that they provide a form of prequalification to a third party. So a lot of times when you post a letter of credit, the beneficiary is someone you're working for, someone you have an obligation to, or the word an assurance to. The main difference between a surety bond and a letter of credit is 90% of the time, and I say 90% because there are very few exceptions for maybe the Apples and the Googles and the very strong credits in the US. But in essence, a letter of credit is typically collateralized back to the bank. In other words, you need a letter of credit for $1 million. The bank will want typically some form of cash security backing that letter of credit for the bank to be able to issue that. So they're generally secured by cash, whereas a surety bond can do exactly what a letter of credit can do, with some exceptions, and we'll talk about those in a minute. But it can do everything that the letter of credit can do, except that a surety bond, when it's issued and when you sign an indemnity to that surety that Stefan talked about earlier, it is a form of unsecured credit. So you do not have to report it on your balance sheet as debt. A lot of times when we look at financial statements, we see letters of credit on the debt side of the balance sheet. That's because it is a form of debt. It's secured by collateral, and the bank and CPAs require that you list those letters of credit as debt. So if we can convert a letter of credit and replace it with a surety bond, why is that important to CFOs? Is immediately you've gotten debt removed from the balance sheet, which is a huge advantage and can be a real game changer, whether it's or cash. A lot of times we see the term restricted cash on a balance sheet, and we remove that. We replace the restricted cash with a bond, which means the cash comes back to you as a client, which again improves the balance sheet. Rates are very similar. On average, we, depending on the financial strength, again, we talked about character and capital being the main driver of how we structure our rates in terms of the pre-qualification by a surety. But letters of credit, generally speaking, what we've seen have rates that run from 1% to 5%, including standby fees, legal fees, and so on. When we're talking about surety bonds, they range from under 1% to 2%. And they don't have other fees. They don't have legal fees. They include our fees. They include pretty much everything. Whereas letters of credit will have standby fees and other fees associated with the surety, with the letter of credit facility, in addition to the letter of credit itself. For those of you, obviously, many of you understand that UCC filings are important. They put in essence, a recording of debt against assets, and that happens a lot of times in letters of credit. If the letter of credit is securing a project entity that you have, or a project that needs a letter of credit, the bank will often take or register a UCC filing against the asset of your company. The surety bonds, surety company does not do that. So that's another advantage. Again, all these are somewhat related to the fact that it's unsecured credit when we're dealing with surety bonds. So it doesn't affect your borrowing capacity, whereas a letter of credit is part and parcel of a debt facility that you have with a bank. Let's move on to the next slide, Stefan. So let's talk about real world scenarios. And what I mean by that is it gets back to Robert's question about where are bonds found outside of construction. So when we think of the surety industry, we talk about it being a $4 billion business. Over 60% of that is found in the construction sector. And obviously, if you're a construction company, you know what surety bonds are. You run into them, generally speaking, if you do public work. We're here to talk about the fact that there are so many opportunities to utilize surety in areas outside of construction, which is a growing space in our industry. And so a few examples of those, again, if we think about the fact that a surety bond is a form of financial assurance, anytime you have a financial assurance requirement, it is an opportunity to say to yourself, wait a minute, this owner, this contracted party that I'm working with requires us to post cash or a letter of credit. The thought should be that we promote is for a CFO to be saying, wait a minute, is there a possibility to provide a surety bond here because of the advantages that I spoke of earlier? And again, not just based on rating, but also based on the fact that the bond has advantages that it's not dead and so on. And so let's talk about a few examples. For example, we have if you're a developer in certain states in the US, the developer builds a condominium project and receives deposits from the future condo owners or the condo owners in the amount of 10%. Now, they can't use that 10%. They have to leave it in an escrow account. You can post an escrow deposit bond to the state, like in Florida, Washington, many other states, where basically then that developer is able to use the depositor's monies for their working capital. That's a huge advantage to a developer. So just by the very fact that we're posting that type of bond frees up cash. We have lease bonds. A lot of times our clients can be a tenant or are a tenant and they have a lease agreement. The lease agreement requires a cash deposit or a form of cash security during the whole term of the lease. And a lot of times it requires a letter of credit. Many times we'll structure a lease bond with that third party and say, will you accept a lease bond if it can do everything that a letter of credit can do on behalf of our tenant? And so we're able to negotiate lease bond language, very similar to letter of credit in the sense that it's just one-page document that says, this underlying lease, we guarantee that our client will make those payments, those rental payments. And so if you think of that, I like to use lease bonds because it affects every industry. Every industry can potentially be a tenant. And so I like to use that example because it's a typical example of where you have an assurance. You have to provide that third party with some kind of security deposit. And we are using lease bonds. So we talked about escrow deposits for condominiums. A lot of times if you have a large deductible in your insurance program, your insurance company will want to come back to you and say, hey, you've got a large deductible, 100,000 or more, sometimes in the millions. We're going to need some kind of guarantee because we're relying on you to pay those deductibles for your workers' compensation. And so that insurance company will say, we want a third-party assurance that you're going to be able to make these deductible payments. And typically they want a letter of credit or cash. We're now replacing those with surety bonds up to a percentage. Sometimes it's 50%, sometimes it's 100%. It depends on the insurance company that we work with. Stefan talked about healthcare. Accountable care organizations are healthcare organizations that provide a guarantee to the federal government that they will have a savings in managing a Medicare or Medicaid program. And the federal government has concerns that if there isn't a savings and they have to pay the federal government back, what if that healthcare company is no longer around? This is what the bond guarantees. In the renewable sector, we see decommissioning for solar facilities. So in other words, a renewable company installs a solar farm, again, a very fast growing industry right now in this current administration. And so we work with many towns and counties that say, wait a minute, if you're going to put a solar farm on our space, on our land, how do we know that this solar farm is going to be decommissioned when it expires in 30 years from now? And so we want to guarantee, and historically they've only always wanted, or they've asked for, letters of credit or cash, and we're replacing those and negotiating those by posting surety bonds. One last example that I'll give, and I'll allow for questions here, or I think we have one more slide, but we talk a lot about other industries like financial institutions. We work with banks who receive deposits from large institutions. I have a scenario with a Texas-based bank that received deposits from municipalities across the country. And that municipality is saying, look, I'm only protected to up to $250,000, which is the FDIC amount of insurance. What about if I give you a $5 million deposit or a $100 million deposit? Where's the backstop that, you know, if you disappear as a bank, that my money's not going to go away? And so we can provide that third-party guarantee with a bond, which says, look, after the $250,000 FDIC guarantee, this bond guarantees that deposit from $250,000 all the way up to hundreds of millions of dollars. And what that does is it gives the municipality comfort that they can now post their monies with maybe someone other than Bank of America or the top-rated banks that might pay lower interest, whereas you might have a mid-tier bank that is going to pay a little bit higher of an interest. And this, for a very small amount of money, posting the surety bond gives the ability of the bank to say, dear depositor, I've got a backstop on your funds for you. So these are some examples of where we're utilizing surety bonds in what we call the commercial space, which is anything that's not construction related. I think I saw a quick note, someone talked about software. Suppliers, any type of supplier that provides a guarantee that they will deliver, a solution that's software based, or a solution that is performance guarantees, that is not construction. We see these miscellaneous type contracts where states or even private owners are saying, give us a performance bond to guarantee that this will be done. And it's especially important when there isn't a lot of backstop relative to finding a replacement party to do the contract. So in software is a perfect example of that. There may be no one else other than your firm that can do that work. And so the third party that you're doing that work for is going to say, well, if we have to start over with another company, let's get a bond that at least will pay for the full amount if there's a problem midway through this contract. Stefan, is there another slide? I think there is. There we go. So here we've hit the end. Those are some real world examples. Hopefully that was helpful in understanding where surety bonds can be utilized outside of construction.
Carl, I'm going to hit you rapid fire with some questions. Question number one, on the cost of a bond, you mentioned an average of around 1% or less of what? 1% or less of what?
Should have been more specific. Thank you. It's 1 or 2%, anywhere from, I call it 0.5% is the low mark, all the way up to 1.5% to 2% of the bond amount. So if you have a lease agreement, that's a $5 million lease for over 5 years, and the owner, the landlord, says we want a security deposit of $1 million. That would be, you would pay the 1% on the million per year.
Carl, you mentioned length there. Is there a normal length surety bond providers are willing to provide, and is there something that then is considered long-term that maybe has an additional premium?
Great question. So back to your first question, which is rates are generally speaking annual in nature. So if we do a long-term contract, we're still going to charge, like a letter of credit, we're going to charge an annual fee for that. Now, I'm sure you're not surprised by my answer. Relative to duration, it depends. And so a lot of times what we do is a letter of credit can go out for what we call is done with evergreen language. Evergreen meaning the letter of credit renews automatically every year. Surety bonds, in order to compete with this evergreen language, we do surety bonds that do the same thing. They renew automatically every year. However, to guarantee that they can go on for longer periods of time, in certain cases, we're able to structure what we call forfeiture language. And without getting too far into the weeds, it basically says that if the surety does not renew that bond for a long-term obligation midway through, the beneficiary of that bond can actually make a claim on that bond for lack of renewal. That alone can be a cause for a claim, as opposed to deficiency or a defect in the underlying contract that we're bonding. Hopefully not too complex there in my answer.
Yeah, no, that's good. And then I think you just answered this. It was a question around timing of the bond premiums paid. I assume it's like the early part of the process. Let's say it's just a 1-year term. Is it immediately to receive the bond? Are there payment plans? How does the payment work for cash flow purposes?
Yeah, and I'm going to use a letter of credit differentiators or differences, so people here can who are listening can clearly understand the difference. So with a letter of credit, oftentimes you pay quarterly. There may be some fees up front. With a surety bond, it's a little different. The first year is paid up. Each year it's paid up front. The first year is non-proratable. So if you need a bond for 3 months, the difference is it might cost more because we have to charge it for the whole year. Now, the difference is, or where there is no longer a difference, is after 1 year. So if, for example, you have a multi-year lease or a multi-year obligation, or if you're doing a comparison between a letter of credit and a surety bond, after year 1, you still do, Robert, pay the whole year premium up front. But if you cancel it on day 2, you would get 363 days back of your funds that you've paid, or the 1% on the bond amount. Now, remember that a lot of times we can be at the same price, or maybe you have a 9-month project and the bond might cost a little more than the letter of credit. Again, why our CFO clients still value bonds highly is because it is not debt, and because they can get money back, or because they can reduce debt on the balance sheet.
Carl, if I've got to go out and shop and I'm the purchaser, it's a requirement for me to do some business. With these indemnity clauses, is there any gotchas, anything I should keep an eye out for, that maybe one carrier or provider is a little more aggressive in the language of what somebody might have to pay if things go south? Any difference between the carriers, best and worst, or is with the indemnity, is it just a common clause? They're all gonna get you for everything.
Well, the indemnities, as you can imagine, are very one-sided. The surety wants to have the ability to rectify a claim, and if they do find that you are in default, the difference is, as Stefan had mentioned earlier, the surety is your partner. So a lot of times with a letter of credit, when a demand is made, the bank is not going to make an inquiry back to you as the client and say, is this a justifiable claim? The difference with surety is that even if we have to pay in a very short period of time, the surety is still going to come back to their client and say, we have to cut a check in 10 days per the bond agreement or the underlying contract. Please research this, find out if maybe there was an error in the claim request, but otherwise you need to pre-fund us in that 10-day period. And so the indemnity agreement needs to have that strength to say, look, if we do find that you're at fault and you haven't fulfilled your contractual obligations, we do need you to pre-fund us. Unlike a bank, we don't have the money up front from you, so we do need you to pre-fund us. And so that's why these indemnities are very one-sided, because they have to have the ability to make obtain these funds from you or to work with you. And the other part of the indemnity, and I'll talk about the differences in a second part of your question, Robert, but the other aspect of indemnities is they just need the ability to work with you and to negotiate an acceptable claim resolution relative to the owner. But if there isn't, they do need to have that sort of right to step in and say, look, we've done our research and investigation, we side with the claimant, we're going to pay this, and we do need you to pay us back. And that's why it's a one-sided. Are there differences and gotchas? There can be. We talked about UCC filings. Some sureties will loosely talk about the fact that if there's a claim, they want to have the right to do a UCC filing. I like to provide, as the consultant in the matter negotiating the indemnity, I like to tell my clients, to the extent possible, find a surety that will use language that says, in the event of a claim, we may file a UCC or we have the right to file a UCC, not we just choose at any time to file a UCC whenever we want. Even though realistically they never will, I prefer to have language that references that only in the event of a claim will they. It's not really a gotcha, but it's something that I think makes it very clear that it is unsecured until or if there unless there ever is a claim.
Our last couple questions, if we have time, maybe just last one, is are these terms negotiable? And is this something that you need an attorney to review or just a good broker if they are negotiable?
So indemnity agreements can be negotiable. I would say that it's going to depend on how much the utilization of surety as a solution for your business. So if you need one bond for $500,000 or $1 million, you're going to get zero negotiation capability from the surety. It comes down to the partnership, just like you might see with a loan agreement. If you were working with a bank, you're probably not going to get a lot of flexibility if you're a small borrower with a lending institution. The larger you are as a client, the more flexibility you're going to get. I will say this, a lot of times we get into the discussions with attorneys that do review. Sometimes attorneys outside or in-house counsel will review a document. And we do get into a lot of cases where we say, yes, that's in writing, but that never happens. And I know that sounds a little bit pie in the sky, but the surety industry has a reputation to uphold. And if a company started to enforce clauses that were in the indemnity that are very one-sided, you would see this product disappear quickly. And so there's a reputational harm that can come to a surety if they start acting in ways that are not in their client's best interest. And so that's one thing I do like to guide people on is I don't get too stressed about indemnity. They're a worst case scenario, and sureties really are your partners.
Carl, you mentioned partners two-way. In the theory, I'm going to just use construction as an example. If you're doing some cost and scheduling variance analysis and you realize halfway, you're like, whoa, I got a performance problem. Mm-hmm. Do companies call the broker or call the surety company and say, this is looking south, I wanted to tell you ahead of time?
Absolutely.
It's just like okay, go ahead.
I'm sorry. Finish your question.
Oh, I was talking over you. I apologize. Is that like a best practice? Would you recommend it if that is something?
I absolutely would recommend that. We are very strong proponents of again, it's back to the partnership statement. We're strong proponents of the idea that your surety is no different than your lender partner. They want to see quarterly financials. They want to hear about material changes in the business. And because a surety oftentimes has more options than a bank in resolving a problem like a letter of credit example that I gave earlier, the surety might actually look at a situation where you're bringing them in early, Robert, and saying, wait a second here, this is a small blip or there's a supply chain logistic issue. You're running into some financial problems. Let's provide you, and Stefan touched on this earlier, let's actually support you, provide you working capital so that there isn't a claim on the bond, and then you can repay us later. And sureties are more likely to do that in a true partnership scenario.
Perfect stopping point. I still got a handful of questions, but I'm going to pause because I have to close and finish on time. This was fantastic. Thank you so much. I wrote down surety is a lot like co-signing an apartment. I love that. That helps me kind of frame this whole conversation. And it's very interesting, the idea of the potential cost savings or cash flow savings, the flexibility of it. Very interesting. I knew very little about this, and I got to learn. So great job. I really enjoyed it. And if you have further questions and you need to have a quiet conversation, clearly Stefan and Carl know exactly what they're talking about. I'll provide their contact information so you can follow up with questions. And I think the key point here, Stefan, is that Carl is right about something. You need to stop comparing yourself to others, and that you need to compare yourself to you. That's the only thing you can control. Future Stefan needs to be better than present Stefan. So just best your best, and every day try to improve, 1%, 0.5%, any percent. Don't compare yourself to anybody else, okay? Great job, guys. This was awesome. I learned a lot more about Stefan and Carl than I revealed. If you want to know, send me a request on a $20 bill and I will write it on the back and mail you back $1. Have a great day. God bless. See y'all.
Thanks, everyone.